Dave Parker has been a part of many parts of the ecosystem, from Startup Week to Startup Weekend to running Founders Institute, and now has written a very interesting book. So Dave, please introduce yourself a little bit and then dive right into the talk how you want to do it.
Yeah, sure. Thanks, John. Thanks for having me. So John and I have been, I guess we're just old hands in the startup ecosystem in Seattle. So both been around for quite a while in this. I'm going to share on the chat window there. There's a link to my site that has the slides. So if you want to follow along, you want to download the slides, they're there. But I'll go ahead and run through them this way. And the link is also on this first slide. So know that the slides are there if you want to go through them. So agenda-wise today, I'm going to give you a little bit about me. For those, I have a bunch of old friends and new friends on the call, so I won't spend too much time on that. I want to talk about the market valuation drivers. What are the factors as both I think of you all as the first investor in your company, as your startup, and then for the investors as well, the follow-on investors, right? But your first investor is you and your time. So the question is how will your startup make money or become a statistic? So I want to give you the path to making money. And the good news is there's 14 revenue models. If you happen to come up with a 15th, I'm happy to write about it. But I'll walk you through the data of what the revenue models are, how you impact valuation changes in the exit, and then talk about the public company comps to kind of base the data on the public company data. So I think as you look at the data, you'll walk away from it and go like, oh, that's interesting. Maybe I should have a thesis on how I'm going to make money. So hopefully your idea is unique. How you make money is almost never unique. So that's the topic for today, and plenty of times for Q&A as we go through, and I'll wrap up with time at the end as well. So that's the agenda. Quick note about me. So I've been on both sides of the table. So a 5-time founder, sold 3 of them, closed 2 of them. So total raised about 12 million, exited about 85. John and I just missed overlapping at Startup Weekend. I came in to run global programs for Startup Weekend with COO and launched Startup Week. So if you were around for Startup Week at the kickoff, that was part of the craziness that was self-inflicted by me. Every once in a while, somebody's like, will you do it again? And my answer is, oh my God, I hope not. But you never know. It's kind of self-inflicted. So we also started Startup Next, and then we sold the company to Techstars in 2015. It became Techstars Community Programs. But to give you a sense of size and scale, our last full year there before we sold to Techstars, we did 1,265 events worldwide in 120 countries with 74,000 attendees. And one of the things that we consistently saw, and John saw because he was a facilitator, is people would come out of Startup Weekend, they'd be like, I met John, we're gonna be co-founders, we're leaving our day jobs tomorrow. And I'm like, no, like before you do that, there are some things you can know. And really the book was focused on just that, right? What can I know about the startup? If I have a startup idea and a thesis, what can I go do? So that was the kind of nexus of the book. And I talked with another author recently, he's like, well, writing a book that doesn't help get you be a big card or get you consulting projects isn't very smart. And I'm like, that's true, but startups don't have money they need to spend on consultants anyway. So it's the cheapest way to help the startups out. So I've been a VC a couple times. Was a corporate VC for Mitsui & Company out of Cupertino, California for about 3 years. $250 million fund based in Tokyo and Cupertino. We did 14 investments in our first 18 months. And if you know anything about Japanese business culture, that was playing against type, and we were going very fast, which was very unusual. And then I would call myself a random angel. Most recent deal, I invested in a company in Cairo, Egypt. I spent a fair amount of time working with accelerators globally, and the data that you're going to see around the revenue models is definitely from a global data set. And most of my day job you all know, if you're around the startup community, that's my day job funds my community work. My day job is Mark Upson and I work with Next Path Advisors, and we do sell-side M&A for founder-controlled companies. So I had 2 companies that got closed last month. So that's a little bit about me and a new miniature Australian Labradoodle who's super excited about something. So welcome to more humanity than we've seen previously. the blog content, if you can find the right order of the blogs, you can actually get the book for free on the blog, because there's about 150 blog content there. I just don't know you can string together the order or not, but if you want the free version of the book, you can get it there. The 14 revenue model excerpts you can get there at the, there's a free excerpt version. I'll put it in the post as well. So if you're interested in the excerpts, I would encourage you to do that as well. I should have had that one pulled up for you. So here that one is, and you can download the excerpt for free of the 14 models. And then as I've learned in the book publishing world, the answer is please buy the book, because that's what my publisher always reminds me. What can we do to sell more books? Ask people to buy the book. So there you go, mission accomplished. So my note to you is ignore the memes, because if you follow Twitter, you'll see people talk and they're like, hey, the product's the most important thing, or the team is the matters the most, or it's all about the market, or the idea doesn't matter, only execution matters, which by the way is a dumbass thing to say, because it assumes it's a good idea, because otherwise the idea wouldn't matter at all. Or follow your passion and money will follow. Generally spoken from stage for somebody who's already made money and is trying to sell you something. Just a note to self. Or focus on the customer and growth will follow. I would just remind you all that it's all of those things, not one of those things. So I'm going to give you the top market driver components, and this starts to put together all of these pieces matter. As when the last time I was a VC, we had what we called our fast 4 and our slow 6. So we evaluated every company on 10 criteria, but these first 4 were the ones that mattered to us the most. So if we weren't excited about the first 4, then the other 6 really didn't matter, right? And the first one is the market, because big and nascent markets win. And if you look at most of the unicorns over the last 10 years, most of them have launched into new and nascent markets that were never markets before. So big opportunities came from big markets, but typically we were early. The founders were before the market actually matured. And it's one that you can look back on clearly in retrospect. Airbnb is an example, or Uber, but know that having a big market really matters a lot. The reason I bring that one up is that because even a great team in a meh market will probably have a meh result, but a marginal team in an amazing market can still have an amazing result. So when I started the book, I would have told you I came from the Techstars Startup Weekend train of thought, like team, an idea. And now I tell you market, and team, because I think market matters the most. So team is next. Obviously, solo founders are rough, because you're going to have to pivot and make hard decisions at some point. And as a board member or a random angel, I'm not going to be there for you. It's about who is on your team. So if you're a solo founder, the answer is probably not going to get funded, at least by most of the angels and VCs I know. You can get funded by friends and family. Just make sure they get the best deal, because otherwise, holidays are super awkward. Product is the next thing I'm after. Is the product sticky? Is it killer? Do the customers love it? Like, I want to know that the product's like super sticky. And if you ask the customers about the product, they'd be like, oh my gosh, I love that. That's amazing, right? So third component to me is really product. If you haven't seen Bill Gross's video yet, Bill Gross started a company called Idea Lab, and he has a great video on a TEDx Talks. It's actually under the TEDx normal limit of the number of minutes. And he talks about the importance of timing. And what he and his Tim did was they went out and looked at 100 of their portfolio companies and 100 other portfolio companies. And they talked about why the market timing is really, really important. So I would encourage you to take 7 minutes and look at that TEDx video. It's brilliant. And he looks at it, of all the reasons, like, was funding, was it the team, was it the product? And in retrospect, for a guy who started a company that was called Idea Lab, he would have told you that the number one reason for success or failures and disproportionate outcomes was market timing. So just know that as a founder, we tend to look at those things looking backwards, and you have to kind of see around the corner as a founder. As a VC, I would tell you most VCs look at this and said, our timing was really great on that deal. And the answer is they didn't actually do anything but write you a check. Like your timing was the timing that really mattered. But you have to be able to see around the corner a little bit to have good timing. So next one is competition. So you'll hear very frequently, if you have no competition, none of the investors will like it because it's like there's probably no market. The contrasting side is if somebody has raised $100 million in the market, or 2 or 3 companies have raised a couple $100 million in the market, they've effectively sucked the oxygen out of the room. So know that the competition matters there. There's some, incredibly hot markets right now. So things like virtual event platforms right now are super, super hot. And we see a lot of that from a competition where the oxygen's have just been sucked out of the room. Traction is early indications of success, right? If you're B2B, it's going to be revenue. If you're B2C, it can be users for sure, but know that there's a big difference between B2B and B2C. Your unique economics and your dynamics around traction for B2C are going to be different than your unit economics for B2B. And most often for B2B, it's going to be revenue, 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 letters of intent, proofs of concepts definitely count. But what we're looking for is the outlier of, is there some traction here? And by traction, and I'll get into product market fit in a minute, but by traction, it really has to do with user growth if it's B2C or revenue if it's B2B. So unit economics is the next piece. How do you make money? What's the conversion matrix? What's your LTV to CAC ratio, lifetime value to cost of customer acquisition? Most of the companies that are getting into accelerators these days that I'm seeing are people who have at least a thesis on their marketing spend and what their conversion metrics are. For a lot of founders, they come back and say, well, I'm going to figure that out after I raise the money. And then the answer in that case will typically be, you probably won't raise much money. So know that that's going to be part of the process. So unit economics, and at least have a thesis on how you're going to do marketing past organic growth or past just your own personal network. And the last one is efficiency of capital, right? So one of the things that is, I know there's an investor here in town that invested early in Tesla. Tesla took a freak ton amount of money, right? So ultimately, yes, they went public and their stock has done incredibly well. But if you look at that, the time to convert, right, and the efficiency of the capital, know that if you're in physical goods, or you require physical inventory, or you require shipping from China, right, all of those things are inefficient capital compared to software. Now, it doesn't mean you should change your business, but just know one of the things that investors look at is this an efficient use of capital or not? So those are big market drivers in the valuation of your company. So just know that those are typically the ones we look at and go like, is this going to be a big idea or not? It starts with a big market, the team matters, and then we get down to, is it going to be efficient capital or non-efficient capital? So if you're building a combination of physical device with software as an example. So those are your big market drivers. I point to them because they're less about the things that are in your control, right? They're how the market's going to value you, not how you value yourself. And for us as founders, for many of us, we want to get a unicorn valuation. Why not? I mean, why wouldn't you want one? The problem is you're not set up to actually get one, because you're building a tool, and that tool is part of somebody else's ecosystem, right? Or you're a feature in somebody else's product. So if you think about the latest set of products or features that came out in iOS, I could probably point to a number of them and say that was an app in the App Store. So that Apple saw and said, that has good uptake. We should include that in the next version of iOS. So as much as you may want a high valuation, the fact of the matter is it's going to be, the market drivers are going to set your valuation. So know that that's going to be part of the process. So as much as you need capital, doesn't mean you can raise capital. You want a high valuation, doesn't mean you're going to get a high valuation. So the factors are going to be more part of that. All right. So ultimately, all of these things matter, right? So if you have a great team in a bad market, you'll probably have a meh result. If you have an okay team in a great market, you probably have a pretty good result. If you have a great product with no path to market, it's not going to work. So I met with one founder not too long ago, and they're like, we're going after 6 multi-billion-dollar markets. I'm like, no, you're not. You don't have enough money to do that. You don't have enough money to go after $1 billion market, right? Let alone going after 6. So even if you have a great product, if you have no way to monetize it, like no one's going to invest in that. And an okay product with okay monetization, you'll actually make some money, right? The question is, will it ever be a breakout hit and produce a great return? Because remember, go ahead. You got a question? Or it was probably more of somebody asking about dinner plans. So just know that ultimately all of these factors matter. I need a great market. I need a competent team. Ideally, I'd want a great team. I want a great product. I want solid monetization, and obviously great execution. Those things will give you a monster result. But if you're missing one of those pieces, know that there's a lot of pieces required to make this work, which is why the failure rate's so high, right? So the big question then for you all is to make sure that you think about those things before you make the leap. Ideally, if you've already made the leap, then the idea is how do we compress this time frame for you so you spend 6 months figuring it out rather than 16 months figuring it out. So that's kind of the big aha through the process. I also want you to think about how do you categorize your solution. Investors typically think about this as I invest in B2B. Like I like B2B solutions. I like complex problems that they're solving. I think where there's mystery, there's margin. That's a quote that I ended up finding out after I've used it for years and years, came from a guy named Dave Burkus. We'll talk about the Burkus method later on in the deck. But Dave's comment was, where there's mystery, there's margin. And where there's no mystery, there's no margin. So my first company, we were in a business that didn't have much mystery, right? People know what our costs were. It was a super brutal business. In retrospect, would I do it again? Oh, hell no. Right? So now, did we grow the company? Yeah, I grew the company from 0 to 32 million in sales in 4 years. It was just a brutal business that included some big behemoths in the space, including Ingram Micro and Tech Data, who were 13 and $14 billion in retrospect, right? And did we grow fast? Yeah, we went from 0 to 32 million in sales in 4 years. All the big guys had to do was wait us out. They just keep lowering their price, right? And try to wait us out. So we ended up selling that company in 2002, went from 3 co-founders to 150 people, made lots of mistakes, right? And the question there is, how does a company make money, and does it ever really, do the back of the napkin math make sense? Investors are going to look at it and say, are you in the product business or are you in the services business? Services are people, right? Product is something I can sell when I sleep. Are you selling B2B? Are you selling B2C? The exception here is if you're a marketplace, right? Because people will think about that as, oh, we're B2B to C. It's just a marketplace. A marketplace has 2 sides. You have to have a seller side and a buyer side, right? And we'll talk about that in the revenue models here in a bit. So categorize your solution, because investors typically invest where they've made money before. So if I've made money in B2B, am I likely to do a B2C deal? Probably not. So we invested in, when I was at 7 Peaks Ventures, we invested in an esports company. And I had to go to my now 19-year-old and ask him how Twitch worked. I mean, I saw it was a big exit from Amazon, right? Over $1 billion. But still the concept for me of watching somebody else play a video game sounded kind of crazy. So I had to actually go to who my customer was and try to figure out, right, what the target market is and understand it. So just know that you're going to fall into a category. The categories have investors who like those types of categories. And if you're like, I don't know which one I fall into, then take some time to figure it out, right? Because you'll get asked for sure. So that's your solution.
Hey, Dave, can I push just a quick question for you? My apologies.
No worries.
It's Terrible Raj. And just, Terrible Raj, he has his terrible questions. So Dave, at what point are you like, okay, that's the bottom line, and I'm out. I'm just done. Like at some point, like, here's the number, I accept it. Either I put it to pasture or I accept this number.
Yeah, I think that for all of us as founders,
or maybe just for all of us, yeah. What was like the mental wherewithal you went through?
Well, I mean, I sold 3 of them and closed 2 of them, and I think one of the ones I closed, Raj, was we had found a problem for SMBs So we were doing, I had been super active in the community, and I was running nonprofit fundraisers for Boy Scouts and Little League. And every year since volunteers ran it, every year we had to recreate every ask that we made and who was the person at that restaurant. And so we built a donation automation software product that would be a subscription service that the person running the event could use to track all of their historic donations. And the person at, Cupcakes Royale could run to like LinkedIn to say, I want to automate my donation requests.
Brilliant.
Definitely a problem, right?
Yeah.
So we built the MVP, we tested it out, people loved it. And then what we realized was SMBs maybe could pay $50 a month on that product, maybe, right? Multi-location obviously could go up. But what we saw was no one was on the web looking for donation automation software. So the only choice on marketing and sales was to do outbound sales.
Yeah.
So if you know anything about SMBs, right, the good news is SMBs it's the largest population of customers. Oh my God, that's amazing. The drawback is they got, 100 things on fire, and this ain't one of them. Right. So we would call and say, hey, do you want to donate or automate your donation request process? They're like, no. They're like, yeah, theoretically, yes. But do we really is it urgent? And the answer was not urgent. So then
David, like, I apologize. Yeah, well, the last question, I apologize because I'm sure we have to go. Then at what point are you like, okay, pain pill or vitamin? Like, were you like, nope, that's a vitamin, and then you were straight up done?
So the math, so we ended up selling the company,
a
straight asset sale. We sold it to a company that did auction management software because for them it was a feature. So the answer was I landed it, but it didn't count it I didn't count it as one of the ones that landed.
Okay.
Right? Because the answer was, maybe this is useful to you. Good luck with it. Okay. Right. But the hard part is it was not, the economics were inverted. Yeah. Right. So my lifetime value was maybe $600, but my cost of customer acquisition was, $800. Right. So the challenge there was it was inverted from the start. So I think the easy solution is when you look at the math and you're like, I don't see a path to figure out the unit economics. The answer is you have to be able to do unit economics at reasonable prices. And if you can't, is it really is it really a problem, vitamin or pain pill? Either one. It doesn't matter if the economics don't work, it doesn't work. So, and by the way, anybody, you can ask questions as we go. It's totally fine. Yeah, I've worked at some nonprofits. Not all of them were intended to be nonprofits. Just remember that. So one was intentionally a nonprofit. All right, so I want to break down business models for you because one of the things that I get frequently is people like, that's in my business model. Like there's this magic black box that has all these, fairy dust and unicorn farts in it, and it's in that black box. So I want to break down the business model into its components, and I'm going to let you see what the components are and take all the mystery away for you. So first off is how do we create value? Creating value is your product or service, right? It's your market and your team. So if you're doing a services company and you're doing consulting, that's how you create value, right? So I have a team, they deliver services, we mark them up, right? That's my creation of value is the consulting services I sell. If you're building a product, then it's the value they receive in the product. So that's creation of value. So that's product first, right? Which is great, good place to start, but it's not product solo. The next piece is how do you deliver value, which is your revenue model, your pricing, your marketing, and your sales. So this is all in the cost to sell. So the first one is my cost to build. This one is in my cost to sell. What you have left over is capturing value. That's your top line revenue growth and your net profit. So, and by the way, you can't change that one, right? They're determined by the first two. So I have a cost of building the product. I have a cost of selling the product plus my price, which gets me to my top line revenue growth and my net profit. So to break those down for you a little bit more, in creating value, it's the cost of the team. I have to do engineering, I have to do design, and this can be 1099 or contractors or employees. It's all about the cost of building the product. Hosting it, if I'm building or manufacturing something, I have to have the cost of manufacturing. And plus I have the cost of delivery and support. Now this is different than sales. So delivery is the actual fulfillment of the product in a shipping standpoint, or support might be a customer support agent or customer success agent, depending on where you put them in your P&L. But the idea here is to create value. I have to let the customer buy my product, use my service, use my product. So those are all of your costs associated with actually building and delivering the product. So that's how you create value. Delivering value is your revenue model, and I'll break down the 14 for you here in a little bit. Your pricing, which ultimately is a combination of art and science, right? There's a little bit of science to it because competitively you can look at all of your competition, what they charge, what market drivers are. You can look at their history of what they've been charging by using the Wayback Machine. Whole different seminar on pricing, but know that pricing is more in your control than you think, and most founders start their pricing too low. Where I would encourage you to start your pricing high, give a discount for the first year or 6 months, but set the expectation that price is going to be up here, and give a promo or promotions to lower the cost in the first year. Because you can always go down. It's just freakishly hard to go up. Right? So I'd rather have you price your product higher. The data shows that most startups don't change their pricing in the first 3 years. I think you should look at a pricing committee that happens every quarter. I'm not saying you should change your pricing every quarter. I'm just saying you should look at it from a clinical view every quarter and say, can we charge more for this? So my analogy here for you is, people will say, hey, you have 4 kids. Can you show me a picture of your oldest one? I can show you a picture of Brandon when he was 2. He's now 28. It would be true. It's just not accurate. And for you all as founders, the problem is that you remember the product when it didn't have very much functionality and didn't have more things to it. And the answer is you continue to make it better, but you didn't make the price higher. And I would encourage you to look at pricing as one of the variables that's in your control. By the way, if you could raise price and raise less money and keep more equity, I would. That's like such a no-brainer. So, Luke.
Yes, I'm terribly sorry to interrupt, but I just had a question about that. I worked at
permission granted.
Thank you. I was actually in the military, so thank you for allowing me to speak with that. But I guess I'm a little I don't know. Maybe this is why I didn't do well in doing a retail work. But I was informed that you want to keep the price up, like you said. But like seeing on the other side, especially all the way back to when I was a little kid, how Walmart, a whole bunch of places say, "Hey, we've got low prices. That's why you should buy us." And like I kind of am thinking about doing that type of strategy. But I would love to hear your thoughts on it, because I guess with what I'm trying to build and create online, there are other versions about it that are much more expensive. And my thing would be like the least expensive thing imaginable. But I am not the one who has the business experience at all. You are. So I love to hear your thoughts on that.
So it definitely starts with your value proposition and your positioning in the market with what's called your ideal customer profile, or ICP. So the question around vitamin or pain pill that got asked earlier was, is this super valuable to this specific customer? Because I'm not trying to go to everybody. Walmart and such goes to everybody, right? When you launch a product, you're really focused on your ideal customer profile and making sure that you're giving them great value. In exchange for that value, they're going to give you a price. So you can create a product, but if no one's willing to pay you for that product, then you've got a problem, right? Which, by the way, is a great transition to the next slide, right? Which is how do you capture value? Because if you create a product, you figured out how to sell it, and people won't pay you for it, you don't have a company, right? You have a hobby, or you have a nonprofit, which is worse than a hobby, because at least the hobby can self-fund itself and you're entertained by it. A nonprofit, you never stop raising money for, right? Because the need is always there, right? There was a great product called O Hours from years and years ago. John probably remembers. It was an office hours product. They had a little otter as their logo, right? And you could come in and basically use the product for free, or it was super cheap. And after years and years, basically they posted something. They're like, we're just shutting it down. Why? People use it all the time. Yeah, but nobody will pay for it, right? So if you think about Clayton Christensen's Job to Be Done framework, which I would encourage you to read if you haven't read it yet, is he just talks about what's the alternative to using your product. And if the answer is, I'm just going to use a person, right? And it's a jobs to be done option, right? So it's a cheaper alternative. So if people won't pay you for it and you can't capture value, it's not a company. I don't care how passionate you are about it. I don't care how much it changes the world, right? If people won't pay you for it, it's not a company. So know that that's your criteria. Otherwise, it's a non-starter, okay? All right, so capturing value is what's left. It's your top line revenue, it's your gross margins, and ultimately it's your net profit, which represents free cash flow, right? And that's going to be one of the ways that your company is valued. Early on, when you're raising money, you're valued on the size of the market and the kick-assness of the team, right? The more mature you get, the more you're going to be valued on performance and actual data and numbers. So as you go up the capital stack and raising money, it's going to be more about what's your net profit and contribution margin, and those details matter a lot. So you should have a thesis about it in advance, right? So don't start without a thesis for this. All right, that's capturing value. So those are your three parts of the Venn diagram. They need to be addressed, all three of them. How do you monetize? So let me walk you through the monetization options, and I'll walk you through the background on it. Quick note, this is not a calculus of your valuation. Most of you have no revenue. So you have a heuristic, not a calculus. So I'm going to give you some data about that. I'm going to walk you through how to value a pre-revenue startup company from Dave Berkus's Berkus method, which, John, by the way, if you want to ever get him on, I'm happy to make an introduction because I'm a huge fan of Dave.
Please.
And I'll give you a story about Dave when we get to that. So this is not a calculus for your evaluation. This is a heuristic. Heuristic is a rule of thumb, right? I'll give you some calculus at the end as well, but know that this is where we're starting. So what's the background? So somebody came to me when I was running Founder Institute and was making the transition to Startup Weekend and said, hey, can I have a copy of your financial model? And I'm like, well, mine's a B2B SaaS company and yours is a B2C marketplace. I'm happy to give you the model, but you're going to break it and then you're going to want me to fix it. And then it got me asking this question because I'm just curious, right? How many models are there? Like, how many templates would you need to give everybody like the template that you need to do a financial model? So I reached out to the CEO of Crunchbase at the time. They didn't have an API at that point. And I said, hey, can you just give me a list of like every seed funded company in the last 18 months globally? I had no idea what I was asking for. And there ends up being 2,654 companies. So because it took me so long to write the book, I ended up with a 6-year longitudinal study of 2,654 companies, which ones made money, which ones failed, and how much money they made based on the proxy of fundraising amount and fundraising time. So we took that data, hired an offshore team. My son managed the project. He was in college at the time. And we basically went through all 2,654 companies and looked at what was their revenue model, how'd they make money. If any of the team put other in the category, I would reach out to the CEO and say, I'm doing this research project. I'm curious how you guys make money. And I would get into a dialogue with him. So we basically tracked all 2,654. Some surprises in the data. Number one, when I raised my first round of funding, if we called it a seed 10, that would have been a series J. So seed 1 through seed 10 these days, not unusual. The number of seed rounds, and because this is crowdsourced data, it's not particularly clean other than the date of the fundraising round, but the name of the fundraising round isn't always clear. So now that was one of the surprises. Combination models were one of the other big surprises. Was in the VC world, most VCs say, pick a revenue model and stick with it. Actually, the data showed that combination models, so think services plus subscriptions, matured much faster than a single revenue model because they were validating with service revenue early and proving out the concept before they got to scale. So know that that's not a bad thing. But if you want to argue with a VC about it and say, Dave told me otherwise, don't argue with a VC, right? That's just so many analogies you don't want to do there. And then failures, we went back and looked at the failure companies and we used the Wayback Machine. If you haven't done this yet competitively, I would encourage you to do it. 80% of the companies who failed lacked a clear call to action and they lacked clear pricing and value proposition. So what I mean by that is, if I went back to one of the failures and I looked for their pricing page, there was no pricing page. There was no call to action. There was a call us for price, right? More often than not, which is an epic fail. So I would rather you pick a price and be wrong than pick no price and say, call us for price. Let me tell you why. John's my boss. John tasks me with finding 3 vendors who can deliver a particular solution. I go through 10 vendors, I find 3. Yours happens to be number 4. And you say, call me for price. And I have 3 that I have prices already. Am I going to call you for price? No way. Who wants to be on a phone call with a salesperson? Most of you won't even answer your phone if I called you, right? Because I'm not in your directory, right? So no one wants to do that. So I would rather you pick a price and be wrong and go back and change it next quarter than not pick a price at all, because that lack of call to action is systematically failure. Now, were there other reasons they failed too? I'm sure. But 80% of the ones who failed, their last cached page, right? Their last whiff of memory on the internet was they had no call to action. So just know that that's part of the process. So we then took the data, we ran it through Mathematica, and we plotted it out. A couple things you'll notice here, I mentioned combinations. This is down at the bottom, this is seed funding to A funding, and along this side is A funding to B funding. So from seed to A, combination models got funded much faster. You'll notice over here from A to B, gaming, because it's a hit-driven business, got funded much faster. So I would say there were no other really super large surprises in this data set, but I'm going to walk you through the 14 models. A couple of caveats as we go through it. I'm going to give you a list of all 14 at the end. I'm going to have you pick a primary and a secondary, right? Because if you pick one and it's not the right one, you can pivot to the second one. That's all I'm after. So I'm going to walk you through the unit economics of each of them. I'm going to walk you through the models, and then you'll get a list of 14 at the end, and you can pick your primary and secondary. So first one's fee for service. So it's consulting. John and I run a consulting company. We help people with their go-to-market strategies, and we do sales and marketing consulting. So we're in the billable hours business. We are people dependent. Our margin is based on bill rate and pay rate. So if we bill you $100 an hour and we pay Dave $50 an hour, I have a 50% gross margin. The problem is that business doesn't scale, because every time I add a new customer, I have to add more consultants. And I can't just add one customer, I have to add 3 customers. So it's kind of the small business dilemma. Now, is it a great way to bootstrap a company? Absolutely, right? So I do a lot of consulting for pricing, believe it or not, at this point, for big companies, because somebody read the book and they're like, can you help us with price, right? Now, startups don't have any money to pay. Big companies totally have money to pay, right? So consulting is a good business, but it's totally dependent on me, and they only want me, they don't want somebody else. So your key metrics here are project revenue, the dollar amount of the project, your cost of delivering, which is usually time, and that gives you gross margin. So just know that services are not a business that investors want to invest in. So because they just intrinsically don't scale. It doesn't mean it's a bad business. You can still run a lifestyle business. Consulting still pays well for me, right? So, but just know it's not a business I'm ever going to take outside investors for. And when I quit delivering it, the money stops, right? Because it's dependent on, they want Dave, or in my accountant's case, I want Mark, right? So, because I don't want the other accountant, right? And when he quits, he can sell his book of business, but that's about it. So services businesses, by the way, generally sell for 0.75 to 1.5x revenues. So if John and I do $1 million in revenues, the company might sell for $1 million, and we're going to get paid in what's called an earnout over the next 3 years. So basically the buyer is giving us cash in advance that we're going to pay them back for over the next 3 years. That's the way that works. So they can get sold, they're just not great. Second one is called Productize the Service. So if you think about this one, Guidant Financial is a company I've been on the board of 18 years in Bellevue. Southwest Airline is the same. We sell you a SKU, you're buying a product, but behind that product is people and equipment and services. So even though I can buy a product version of it, right, I'm not buying the airplane. I don't get to keep the seat, right? I'm just getting its productized as a service. These businesses trade at a slightly higher multiple, and I'll walk you through the multiples here at the end. Know that what you're really doing is packaging up the product in such a way that the customer can say yes easily and doesn't have to care about the 6-minute increments that lawyers bill that typically do that instead, right? Because I'm not paying for your time, I'm paying for a solution. So that's called Productize the Service. So it works both B2B and B2C. If you guys remember back, Moz recently sold. Before they were Moz, they were SEO Moz. Before they were SEO Moz, they were a services company that were building tools. And at some point, they sold the services division off and they just went into the tools business, right? But that combination of productize the services, we're doing engineering as a service and we're building a product. So a good way to bootstrap a company, just know that it's not, again, not a company that's going to be fundable. So Moz is a good example for that one. Commerce is next, third in the list. So think Wayfair and Lululemon. Amazon today is really a conglomerate. They do lots of different things. AWS is a way different business than commerce. It's a way different business than the marketplace. But Wayfair and Lululemon are two great examples. Wayfair sells somebody else's product. Lululemon sells their own product. They are a niche e-commerce company doing direct-to-consumer sales. And in some cases, if they're successful, selling their product through other retail channels as well. So your key metrics here is your wholesale cost of goods sold, your average margin percentage, and your average basket, and the number of baskets per month. That gives you your key metrics for the unit economics. It can be physical goods, you can do wholesale retail, it can be virtual goods. Commerce is a great model. It's been around a super long time, since the earliest of early days pre-internet. They can mature into a marketplace as well. So it's one of the options in commerce. Commerce is a great business. That's number 3. Number 4 is subscription. I just bought my dog a new chew toy. Amazon gave me the option to subscribe to it on a 3-month basis. Apparently my dog's not the only one that chews through them. So I can now get a subscription to dog toys on Amazon. So subscriptions everywhere is pretty much the norm. It's a great multiple. Subscription is annual recurring, monthly recurring revenues. So know that that's your key metrics here are average revenue per user, ARPU, conversion ratio from free or demo, and churn. Churn means the number of customers who leave you on a monthly basis. So that's the key metrics for subscription. Works obviously B2B and B2C. The ones that do best here is ones that have optimized around tiered pricing. So think DocuSign. So amazingly optimized pricing around price tiers. So the companies that do the best in subscription are ones that have optimized around that. So high multiple, and the reason they get such a high multiple on exit is because they have such great forecastable revenue. I can predict how much revenue they're going to do next year. And as doing sell-side merger and acquisition work, if your revenue is predictable, I can build the case that says we should trade on the future 12 revenue of the company, not the trailing 12 revenue of the company, because your revenue is so predictable. So know that that's the key in subscription businesses. Metered service, in the 5 years we looked at the data, metered service was one of just a very few business models, revenue models that actually changed. So think here, AWS, Azure, Twilio, Splunk, all of these are recurring revenue, pay as you go. The only B2C example I have for you is my old T-Mobile bill. When he first time user, remember when we used to get text messages, pay as you go? Negative customer experience. In the B2B side, it's a positive customer experience because if your customers are using more of your services, you have good markup, right? So that should be the implication of metered services. Metered services have the best multiple of all of the exit multiples I'll show you, and I'll walk you through why. But again, your super predictable revenue. If you pulled AWS out of Amazon, it would definitely be the rock star contributor to Amazon's valuation. So very much like subscription here, except you just have meter service to ratchet up as you go. Next one is transaction fee or rental. They're two different businesses, but they're common in how they charge. So think Stripe here or Chegg. Chegg is in the book rental business. Stripe is in the transaction volume business. In the transaction fee business, you're not booking the top line revenue. You're only booking the fees. Stripe doesn't book billions and billions of daily transaction and top line revenue growth. They only book the transaction fee. So the transaction fee then is the transaction fee revenue, the percent of the overall fee from a profitability gross margin perspective, and the number of transactions per month. This one works B2B and B2C. But just know the only example from this in commerce, you're booking the top line revenue. In transaction fee, you're only booking the fee revenue. So if that's the type of business you are, you'll hear people talk about gross product value or gross market value. And it's like, oh, they're misleading, not intentionally or not, not intentionally. It's just a question of like, if you're selling stocks and bonds and you make 50 bips, I don't care if you did $1 billion in sales. I care about the 50 bips, right? So that's the transaction fee business. Be concerned here if you start your price too low. So for example, marketplaces do transaction fees. So if you remember Odesk, and now it was Elance and Odesk are now, what's the new version of them? They post-merger, they basically had to come back and increase their prices. Upwork. So the CEO inherited that post-deal. They were at 15% transaction fee. They announced they had to raise the price to 20% or they were not going to make it. So don't start your price too low. Have you noticed the theme here?
I got your transaction fee. Why do you have the word rental in your title?
So the rental business is the same economics. So Chegg, for example, rents a academic book for college students. So transaction fee. So if you're in the rental business,
okay,
it's the same. The model's the same. The titles are slightly different.
Gotcha.
Yep. Marketplaces are next. So if you were thinking I'm B2B to C, Dave, you were thinking about a marketplace. Marketplaces you have to get sellers first, buyers second, because if you pay for buyers and there's nothing to buy, you've wasted all your money on customer acquisition. So marketplaces at maturity are in equilibrium. So think Alibaba or eBay, right? Uber, right? Those are all marketplaces. In the early days, you have to have product. So if you're doing marketing, you have to get the sell side first, buy side second. You have 2 different marketing funnels, right? So there's just a level of complexity here. I've had people say, you hate marketplaces. I'm like, no, I don't hate them. They're just hard, right? So because you have two different marketing efforts, 2 different value propositions, 2 different CACs, cost of customer acquisitions. Now, the good news is if you do it right, you build an intrinsic moat, which is awesome. But if you merge all those pieces of data together and you don't track them differently, you've just got a muddy mess. So know that you have to really nail down your unit economics on both sell side and buy side. B2B, B2C, both totally works. We've seen a lot of niche marketplaces that have been super profitable. One trend here is marketplaces take a transaction fee, usually on the sell side, sometimes on the buy side. We're also seeing a trend in introducing subscriptions on top of it, which either gives people access to product a little bit earlier, so there may be a time advantage, or there may be a benefit on percentage on the transaction fee by creating subscription revenue on top of it. So that's one of the trends we're seeing in marketplaces. So combinations, if you know Smartsheet here locally in Bellevue, Smartsheet has 25% of their revenue is services. Because if for a big company to implement Smartsheet, people have to be trained, the Smartsheets have to be designed. So they implemented a service called non-recurring engineering or professional services. 25% of their revenue is professional services. You'll notice that they're a multi-billion-dollar market cap company. The public market doesn't care that 25% of their revenue is non-recurring engineering or professional services. It's at 50 to 65% gross margins. And it compresses their sales cycle on subscriptions. So combination models are legit models. Or as I mentioned with marketplaces, it may be a transaction fee plus a subscription. So there's a number of combinations that work in that effort. Know that, Smartsheet's a great example of it. I would make combinations slightly different than the mega cap companies. Like Amazon has a marketplace, they have commerce, they have AWS. That's at maturity. You guys won't have 3 revenue models at launch. They'll kill you. Like, I just want you to pick a primary and a secondary, but you won't have multiple revenue models at launch. So that's combination. All right, I'm going to cruise through the next ones because they get a little bit more obscure, but you need to know that they're there. Anybody doing gaming? The margins on virtual swords are amazing. Just saying, you can make it once and sell it for a lot. So King and Candy Crush is a great example of that. It's also the only business where you introduce friction to cause pain and create revenue. Right? You make the game hard, but you can level up and you can pay to win. Right? So there you go, winning. advertising and search. This is a legitimate revenue model, especially if you have a path to get to 1 million unique users a month. If you don't have 1 million unique users a month, let me tell you why. So today on my blog, thanks for stopping by the way, and visiting. I have between 3,000 and 5,000 people that visit my blog every month. A great CPM rate, cost per thousand, on a rate card might be $35, which means if I monetize that with advertising, I might get $100 to $150 a month in revenue. So if you're going after advertising, it's a legit model. The only thing I care about as an investor is how do you get to 1 million uniques a month? Everything else is secondary, right? So that's number 10. Number 11 is new media. Technically, this is the revenue model that doesn't have a revenue model, but let me tell you why, because when people say we're going to go viral, this is what they mean. Viral is math. So Snapchat, WhatsApp, Clubhouse most recently, right? Dirk was just on Clubhouse earlier. I got a note that said Dirk's on Clubhouse. So this is the revenue model that doesn't have a revenue model. Ultimately, it will be advertising. So we're going to give you a pre-roll before you get there. We're going to charge that advertising. TikTok's the same way, right? So if you have a B2C company with a plan to go viral, I love it. I've been part of one of those in 20 years. If you have a B2B company and you tell me you're going to go viral, I'll probably write your first check, but I probably won't have to write it because I've never seen one. So LinkedIn had a little bit of viral for a little bit. Slack did some really great thing on network effects of introducing people, but a viral coefficient is just math. So if you're super curious about viral coefficients, happy to help at some point. So K factor is what it's called, and it's just a particular type of math. Number 12 is big data. Love this one. If you have big data, you have to have the data before you can charge for it. So you need, like advertising, this one works when you're mature. It doesn't work when you're early. 13 is lead generation. So anybody remember Mint? The new version of Mint is called Chime. Basically, they're great marketers that get you to come in and fill out a form data. If you've ever got trapped by one of these on the internet for home refinancing mortgage, right? You submitted your form and afterwards you're like, oh, that wasn't really Quicken. That was somebody who sent my information to Quicken and 17 other brokers. So horrible customer experience. You just have to be super great at marketing. It's a legit revenue model. It doesn't happen very often. Number 14, last but not least, is licensing. So remember this one from the software days? You could buy a software license of Microsoft Office. Today you can get it as a subscription. The irony of it is my first company was called License Online. We did software licensing. This is, the market here is one that's just trending away. So it's still a legitimate model. Licensing still works for field of use or for geography, but in general, licensing is not one that's super hot these days. So still a legit model, however. So here are your 14 models. Pick a primary and a secondary. Questions as you pick.
So I actually had one, if I may.
Yeah, go for it.
So would the same mantra hold true for advertising? You shouldn't go too low, just like with subscribers in terms of price, or is that not the case?
Yeah, I mean, you're going to have, all of us are influenced by competitive rates, but you have to do a lot of research to really define what the competitive rates are. And in the case of advertising, if you're building a unique population, you can charge a premium for that based on the unique user profile. So again, it's a question of do the numbers pencil in advance or not, right? So if you can never get the rate card up, then the answer might be, I don't see how I get to 1 million unique users. But in that case, look, the question in advertising becomes, what's my unique customer growth and my customer acquisition? So let's say it's going to cost me $1 million to get to 1 million uniques. Now I can monetize it, but I have to have a return on investment calculation. So that's kind of the back of the napkin math. Dimitri?
Hey, Dave, this is Jeff.
Yeah.
So if I was going to be pursuing like renewable energy credits and carbon capture and those type of things, does that wind? I mean, it winds up being big data, but is that a fee for service with big data as a kicker?
It probably is fee for service because you're probably starting with consulting, and at some point when you have the data, you can sell the data. So look at that as that's likely your combination model. The fee for service maybe doesn't go away, right? It continues to to go, but as you move the big data market up, you now have data that you can turn around and sell. But you have to have the data before you can sell it. Dimitri?
Yeah, thanks. Your comments about Smartsheet gave me some really interesting ideas. But it got me thinking about if the product requires a kind of hand holding for the onboarding. What are your thoughts on that? Does it make sense to have like that kind of offering in parallel with a self-service, or is it better to like go toward one or the other model?
It ultimately, Dimitri, probably comes down to your ideal customer profile, right? So, and who will pay the most for the service. If it compresses your sales cycle, it's totally legit, right? Because if I have to train my team before I use your product, or I can just hire your professional services team to do the implementation, right? What I've effectively done is I've taken a year out of my sales cycle and made it a 90-day sales cycle instead of a 6 to 9 month sales cycle, right? So think about it as it relates to how fast does my conversion ratio happen as well. But early on, what I'm after is show me validation and traction. If the customer will pay you for services and ultimately give you a subscription, great, right? I just want them to pay you for something, right? Versus like, I'm always waiting to pay you. I'm always waiting for the next feature to ship, right? It's like, that's just painful.
Dimitri had a question, his hand up.
Go ahead. Alicia?
Oh, hi, Alicia Adamson. Thank you. Thank you for the talk.
Yeah.
I'm curious about how to talk about the model as we're seeking funding. And so in my case, I have subscription. I have a combination model. But one of the things that I'm looking to do in the future is use the data from those transactions. But I don't want to go into a pitch or talk to event and talk about like, well, here's what I'm doing now, and here's what I'm going to do in 5 years when I have all the big data, and look at me, right? So I want it, I want to sound concise, but I do. It's like there's this turning ball of the future,
Yeah. Well, I want you to have a product vision, right? So, but I also want to know you survive long enough to get to the vision, right? So the answer is depending on where you are, right? If you're in Seattle, I have to pitch the now, right? This is base camp on my way to Everest. If I was in the Valley, I have to pitch, this is the peak of Everest, and however I get there, I'll get there, right? So just know that there's different markets, and the Valley is unique to the Valley, right? So in the Valley, you would leave with the peak of Everest. Here, you'd be like, this is base camp. What I want to know early on around it, I want to know you're not going to go around Everest 17 times to get to the top, right? I want to know that, you picked a tough journey, but it's not like 17 times around. So tell me the now story, and then tease out the future vision story for sure. Like, I want to know it's a big idea, but I also want to know you're not going to die on your way there. Like, that's super important to me as an investor. I don't want to be the last check-in, right? Or the last and only check-in.
Yeah.
All right, let me walk you through some valuation stuff. I'll stay on for some Q&A afterwards as well, but I want to be respectful of everybody's time. All right, so public comp. So in the book, what I did was I gave examples of both the B2B and B2C, and I was talking with a friend. He's like, oh, if you looked at the public tech company comp equivalents. So we built out a list of 207 public tech companies and looked at their multiples as well. So the challenge is I couldn't give you a comparable based on EBITDA, which is earnings before tax and depreciation expense and amortization. What I could give you is a multiple on revenues. So what we did with these is we took their market cap divided by trailing 12 months revenue on a per quarter basis, and we looked backwards. So combination models are hard because I don't know what the percentage of combination revenues are. So just know that these are some more around the pure models versus the combination models. And obviously there's a number of factors here that are massive tailwinds for COVID. So let me change my sharing. So the original data set in the book, can you see the table okay? The original data set in the book was very much focused on here's services, here's where some of my examples. So Accenture, for example, is a predominant services business. Stride is a publicly traded company, Southwest Air and IBM. IBM does sell product today, but most of their revenue is services revenue. And then you get into commerce companies like Wayfair and Lululemon. So these were examples I used in the book, and then we pulled comparably. You'll notice here that subscription revenues are 8 to 12 times revenues, but metered services were 24. So, and then TripAdvisor and companies like this, transaction fees have a much bigger range. So as we went from this original set of 25-ish companies, we actually went out then and looked at the public company comps, and here's the stack rank based on multiples of revenues. So some clear outliers to point to you, and then I'm going to go to the normal ones. So Marathon Patent Company is a patent troll that got into the Bitcoin mining business, and as Bitcoin was going up, their stock went up. So is that a new revenue model? We'll see. Maybe, but we'll know in like 5 years. Snowflake, Seattle cloud company based on metered services, off the hook numbers, crazy numbers. So another outlier. Zoom, massive COVID tailwinds. All right. So let's look at some more of the interesting ones down here. Shopify, massive tailwinds as well. C3.ai, Datadog, Cloudera, CloudStrike, all in the metered services businesses, all in the 40 times trailing 12 revenues. Crazy numbers. Lemonade, Coinbase, transaction fee rentals, again, super high numbers. Folks down here like Unity, Cloudflare, in the well-tuned subscription businesses in the 38 times. Now, one of the revenue models that tanked during the data set, how many of you guys remember Groupon? So a couple notes about Groupon. Revenue models aren't defensible. Anybody can copy it, and that's what we saw. So let me do a quick note here on Groupon. So Groupon, somebody's using their screen. All right, so Groupon, Match.com, Groupon. All right, so Groupon is here, and you'll see that they trade at 0.49 times revenues, because they weren't booking the top, they were booking the top line revenue like Gap, but ultimately they're transaction fee revenue, right? Other companies down here at the bottom of the list that are kind of interesting. Remember Blue Apron was super hot for a while, not so hot. So what you see in a lot of these informations, here's Dell. Dell trades at 0.55 times revenue. So my thesis here for you as a founder and as an investor is, if you have your choice of revenue models, I would encourage you to pick ones that are in the top decile, not ones that are in the bottom decile, right? So subscription, metered services, combinations, great. Some of them are super risky, right? So the ones that only work at scale, that's a problem. So just know that this is the public company data. The current version we're doing with it is we took the same revenue model data and we're applying it to, Raj, you'll appreciate this, we're applying it to the S&P 500. And we're, the family office I worked for about 3 years, we're building a trading strategy to do a trading arbitrage on this and see if it works. So we did a 5-year regression analysis on these and came back and said, we think there's something here, this may be a good trading strategy. All right, back to the slides. If you're curious about that piece of data, let me know. I'm happy to share the data with you if it's useful, and love to get other people's feedback on it, because I clearly have spent way too much time thinking about geeky stuff like this. All right, so public multiples we went through. So a few last notes on valuation impact. In our world, in the sell side of what we do, we always think of it used to be called the rule of 40, it's now called the rule of 50, is do you have 50% growth or 25% growth and 25% profit? That's super interesting discussions. If the business is going flat or plateauing, harder to get funding, harder to sell. Could be a good lifestyle business, may not be fundable. Logical acquisition and upmarket buyers. So on that list, who's doing business in a category you'd want to talk to them? Keep secret sauce secret. Tell them what's on the website. Most of them haven't read it. You can build relationships and find upmarket partners in business development. Business development is different than sales. It's long-term relationships with people who could be your long-term buyers. And then creating competition within buyers is super important. So summary here for you, and then we'll go to Q&A, but let you get on your way. So Dave did not say, this is a method I can use to tell John what the value of my company is for SAC 20. That is not what I said. These are a set of heuristics you can use to understand if this is a good business decision for you and other investors. If you want to see what Berkus talks about in the Berkus method, Dave wrote 20 years ago, how to value a pre-revenue startup. Like your market's kind of worth this and your team's kind of worth that. And it only applies for really generally US and West Coast companies, right? But Dave did a great job of it. And Dave actually wrote a blurb for the back of my book. I sent him a copy of the book and said, hey, I've quoted you twice in the book. I know I don't need permission because it's already public, but I'd love to have permission from you anyway. And he read the book and actually wrote a blurb for the back of the book, which was super awesome. So not going to worry about buyers. You guys are too early. The data is still a work in progress, right? And the COVID data definitely skews things. But in general, I will tell you the trend is highly tuned subscription revenue models and metered service businesses perform disproportionately higher. So give you an example, Google and Facebook, the two largest advertising companies, Google trades at 7 times trailing 12, Facebook trades at 9 times trailing 12. They're the most efficient advertising businesses out there. If you can get a 3x increase on your multiple without ever being in the advertising business, I would go there if you can. Ultimately, customers are going to buy the way customers want to buy. So you can't force them to buy meter services if they're buying transaction fees. But if you have a choice, think about that. Ultimately, you have to get a product market fit, right? But getting the product market fit will help by what revenue model you choose. So that is it. So what questions do you have for me?
So I don't see any hands going up or people raising their hands. All right. Or Steve has raised his hand.
Go for it.
Steve.
Oh, no sound.
There you go.
Hey, Dirk, can you mute?
Oh, here we go. Can you hear me now?
Yes, sir.
Oh, great. Good stuff. You made a comment just in passing that I think was interesting about keeping your secret, protecting your secrets. I wonder if you could elaborate on how much information startups should put on their website, how selective they should be about who to give demos to, how deep you go into a demo so you don't spill the beans and give your IP away to a competitor.
Yeah, I mean, so Dan Shapiro is another entrepreneur in town I've been friends with forever. And Dan made a comment one time that ideas die from a lack of exposure, not from overexposure. And I found that to be incredibly true, Steve. It's like if you and I had the same idea and we're on stage at the same time and we left that night, we would end up going totally different directions, right? Just because life experience and all. So I would generally say, if I talk to a founder and they're like, hey, would you sign an NDA? I'm like, oh my God, no. Right? Because I know how many things you have to get right to make this work. And I could never keep track of the NDAs from every deal I've seen, right? So I would go out and talk with as many people as possible. And I would look for a reason to kill the idea as fast as I could and pivot to a new idea, right? Or I'd look to get feedback in customer discovery around which feature should I get shipped first. So I'm probably the contrarian. Well, I'm probably not the contrarian, but from a first-time founder perspective, I'm like, I'm going to keep the secret. From a repeat founder perspective, I'm like, I'm literally going out and saying, hey, I think this idea is stupid. John, tell me why this idea is stupid and I shouldn't pursue it. I will tell you everything about, like, knowing full well nobody could actually duplicate what I know in my head. So I'm willing to be a little more aggressive about that for that reason.
Yeah, that makes sense. I'm just curious. So you threw me off with the protecting secrets comment. What did that relate to?
If you're talking about an upmarket buyer, like the person who is likely going to buy my company at some point, then I'm only going to tell you the stuff that's on the website.
Okay.
Right?
Okay. Yeah. So prospective buyers.
If we share common customers, I'm going to talk to you about my common customers. Yeah. I'm not going to give you my product roadmap in any detail, but the big market buyers, keep in mind, they have two things you don't have, right? They have revenue and they have customers. Mm-hmm. The thing you have that they don't have is innovators. All the innovators are left.
Makes sense. Awesome.
Right? Yep. Deborah.
I like that you said big data is on the mature side. You want to talk about companies and startups and big data?
Mm-hmm. Yeah, I mean, big data companies are awesome if you have the data to sell early. Like there was a company I saw that came out of the Hutch, right? And they had this massive data set. And so they could start selling big data out of the dock, right? But if you don't have the big data, you have to build a path to get to it. So like in one of the portfolio companies we had, they came to us at their annual meeting. They're like, we're going to switch to big data. And everybody's like, yes, that's awesome. And I'm like, how are you going to survive the 18 months? And they're like, we didn't think about it. Right? Because you had to go raise money to survive it. So that was kind of the big question for them, is how do you do it?
But if you have a path to big data, it would be an attractive life cycle for a company. If you have like a combination model that leads you to big data, that would be very attractive. Okay.
Yeah, for sure. You just have to have a timeline to get there.
Got it. Thank you. That's exactly what I was looking for. Thanks.
Yeah, I'm sorry, the dog was mine. I would.
Another question, if I may.
Yeah.
Does it make sense to try to coerce subscription model into a metered pricing model? For example, one silly example is if Google Drive were to charge per the number of documents you have or whatever, or the amount of storage you're using rather than per seat. Is that some way to potentially innovate in and capture more value?
I think the answer, Dimitri, is yes, if it's B2B versus B2C. If it's B2C, consumers want to have predictability.
Yeah.
If it's B2B, then I know I'm getting great value for the value received, but I still need to get a path to predictability. So I can't be like, oh, I have wild swings in my pricing on a monthly basis. That's bad.
Right.
But like with AWS and Azure, I can look at it and say, like, the more I use, right, the more I'm going to, but the implications is I've got margins on top of that. So HubSpot went the opposite way with this one. By the way, they started originally, they're the great example in pricing when you look at the Wayback Machine. They started originally charging based on the number of contacts. And then a bunch of people are like, that's, like, how do I, like, I want to get all my lists from all these different places into HubSpot. And then they switched to number of active contacts. So I could dump all my databases in there, but I would only get charged on the number of people I was actually actively outreaching to, which made it much more approachable for the customer. So know that that was one of the pricing dynamics that I think really made it work for them.
Cool.
Carly?
Yep, you mentioned virality and viral coefficients and all about that. How do you judge that without just being like, oh, I'm going to go viral, everyone's going to love it?
Everyone's going to go viral. You go viral, you go viral, you go viral. So it's the math is greater than 2. So for every paid customer I get onto the system, so they're not paid customers in the case of Clubhouse today, but for every new customer I acquire, how many people do they invite? Of the number of people they invite, let's call it 10. More than 2 need to sign up and become active users, right? Or paid users, depending on the economics, right? So the concept there is you have word of mouth, network effects, and viral coefficient or K factor. Word of mouth is just normal, like, oh, that's really cool, you should use it. Network effects are things like WhatsApp, where the app works better when my network is included, right? And then viral coefficient says, I can do the math. For every paid customer I acquire, they're going to invite 10. Those 10 are going to convert to 2 that become active. If it's greater than 2, you have rainbows and unicorns and butterflies, and it's amazing. Like classmates.com was the one company I worked on with that. I was on the board, and we had 2.03. So we were dialing in our ads every day. Like, we were tracking, but you have to have the mechanics to track it, right? So know that that's the key factor there. If you're B2B, the answer is word of mouth is awesome. Network effects are great, but you'll never go viral. So
how would you think of that for a marketplace where you're going to be bringing on sellers who already have their own customer base or their own audience?
Yeah, you'll have great network effects, and you need to be able to track that, because then you can build your economics around that lifetime value. Mm-hmm. Right. So let's say, so initially you're not going to calculate your lifetime value any greater than 12 months, because it'll make us, all of us as founders are a little bit delusional, right? So if you're like, oh, I have a 48-month LTV, I'm like, no, you don't. Unless you have 48 months worth of data. In that case, I'm like, okay, right? But other than that, it's 12 months. That's it, right? Because otherwise it'll skew your data. So my example of the company I sold, right, there was a small business company. Our first year value was $600, but our cost of customer acquisition was $500. Like, I'm like, that never pencils, right? Unless my LTV goes out to like 10 years, right? But that's not a calculus I can make in the early days. It's too risky. So that's kind of that's the back of the napkin math in the marketplace as well.
Sounds good. Thanks.
Yep. Jeff?
So, hey, you brought up team in the beginning, and I'm one of those solopreneurs I'm not an inventor, I'm an integrator. I've got 4 companies that have products that are coming out of PNNL. They're looking for pilot demonstration projects. Do I get to count their teams as part of my team for the project, or
No?
no?
So the challenge there is they're not part of your intellectual property or an asset.
Right.
So let's say, for example, the company didn't work, but you had 10 engineers. If I did an acqui-hire, your cost per engineer would be $350,000 to $500,000. If those people didn't work for you, it's not an asset.
Right.
Right. So the same thing is true there. I think the good news is that you've got some market validation and halo effect. The bad news is you're not going to get a great multiple.
So I'm looking more to license their service and product then to make my whiz bang go with their products.
Yep. Just know you'll need to have a team of your own to be fundable in most likely.
Okay. Thank you.
Yeah. John?
I had a what is it me or John Seacrest?
John, Aaron, go for it.
Thank you.
Too many Johns.
How much, possibly, how much does locality matter?
Great question. A lot
I'm in
less
the
than it mattered 2
sleepiest
years
town.
ago.
I'm in the sleepiest of towns, and I'm far from Seattle, but I'm happy to be here, even a little bit late.
So we actually did an analysis on this because we were looking at doing a venture fund that was based on arbitrage. So we benchmarked the pitch book data and looked at all the Series seed rounds and Series A rounds in Seattle and said, what was the Series seed and Series A and the Valley, and what was it in New York, and what was it in Kansas City, what was it in MENA, right? And so the answer is pre-COVID, if Seattle benchmarked at 100%, the Valley would be 165%, New York would be 130%, Kansas City would be 78%, and Cairo would be 18%. Right, based on access to capital, traction, size of market, et cetera. So the answer is pretty broad, but I think it matters a lot less now than it did before COVID. So what we're seeing is people are less geography centric. So it used to be a fund would be like, we invest in this vertical, we invest in this stage, we invest in this geography. Now, having been a VC, right? So going after my own kind here. Having been a VC, I will tell you they're fundamentally lazy. If they can't drive their Tesla to the board meeting, they probably won't invest in you. Now, if you have a really cool idea and people love the idea, they care about you first. The institutional investors care more about the other things they have to do on top of it. So angels care more about you and passion in the market. VCs care more about the other stuff because I'm investing somebody else's money versus investing my own money. Hey, Carlos, go for it.
So there's 14 revenue models you had. There's a 15th one that I've become acquainted with some time ago.
Nice.
In healthcare, there was a company some time ago that sold a product into one narrow part of the hospital. But they expected that once it was there, it would start migrating. But they never really sold. They leased it. Mm-hmm. And the lease had a provision that you could roll it over when it was done, but you couldn't cancel it. Well, when they sold the next one to a different department, that was a new lease. And the next department, that was a new lease. So if the hospital wanted to switch to their competitor, they actually had to pay off all these leases that had different expiration dates. And it was, it was a lock. Now, eventually, hospital chains become the predominant buyers, and they leverage them sort of out of that model. But we're exploring a similar model with the one exception is that we also have a series of disposables, which are about half the revenue. Mm-hmm. So we have the idea that we'll start in a narrow focus, we'll expand other markets. We want to do a leasing kind of process, actually a little different. It's a per use product. Mm-hmm. So, every patient day that uses this product, they get charged. If they don't use it, there's no charge. But yep. they can't walk it out. But then there's always these disposables that go along with it. Yep. That are used like hundreds of times a day, and they're costly.
Yep. Yeah, we invested in one medical device company that was basically a subscription plus disposables, and I would kind of look at it that way. The lease is really a pricing mechanic, and I'm definitely focused on tech. Like clearly my data skews to tech versus healthcare, but Yeah, ultimately, I think the transparency question you bring up of why they had to change is something I would probably avoid, because generally a negative customer experience is a legal and legal process more than it is a pricing process. But you know the healthcare market better than I do. So, and my data is definitely skewed to tech.
Well, but nonetheless, that model might apply to other markets.
Maybe. Yeah, I haven't seen it done. Again, I'm totally open if there's a 15th. I just haven't seen it done in tech yet.
Yeah, the new way is to avoid the lease and just do a per use basis.
Yep, for sure. So, other questions?
Yeah.
What's that?
Holly has a question.
Okay, Alan, how are you?
Hey, good. How are
Hey,
you?
by the way, I'm going to give a shout out to Alan. Alan helps train junior high and high school kids on entrepreneurship in Bellevue. It's super awesome. So I got to come in and be a guest speaker in one of Alan's classes. But what a patient dude to get to go like, oh yeah, that's a good idea. It's probably not a good idea, but I'm gonna super encouraging. So
it's definitely inspirational.
Want to work with youth? Reach out to Alan. Go ahead, Alan. What's your question?
Absolutely. Thank you, Dave. Yes, and if anybody in here is interested in educating the next generation of entrepreneurs, please reach out. Your comment about sucking out the air, the oxygen, when there's this huge round of investments. So I'm right now focusing on headless e-commerce, which is, in my vision, the future. So it's funny that you mentioned $100 million, because there's another company here in Bellevue that just raised $100 million. And I could have taken that as a good sign, saying, okay, so there's a lot of, it's kind of validating where I want to go. Sure. But it's also, like you mentioned, I feel that how in the world am I going to do anything when next door we have this company that just raised $100 million?
Yeah, and they have a big team. By the way,
massively, insanely good team. Yes.
We have hot air balloons that go past our house. The dog sees the hot air balloon. That's what it is. So if you can find an ideal customer profile that they're not targeting, that gives you a unique go-to-market, and it's still a big market, then I'd say it's definitely worth pursuing. It doesn't mean that one is going to win the entire market.
Right.
The point is that you're always going to be compared to those guys, because both proximity and how much they've raised. Right. So know that there's, if you can go define your own space, right? Or you're like, yeah, we are like them, but we're for this market over here, not for their primary market. Right. I would look at it as a way to differentiate around your go-to-market.
Okay. Thank you.
Other questions from folks?
This is Jason.
Yeah, go ahead, Jason.
I was wondering if you had any thoughts on the future lead generation model, just in general.
So historically, Jason kind of followed the market of, if you look at Google AdWords spend by category, the lead gen business has kind of worked its way down that list in that same descending order. So life insurance, mortgages, attorneys is kind of the descending order to do it. And you just have to be better at marketing than everybody else in the category. So like All-Star Directories was a big market leader in that originally here in Seattle, and they were doing leads for for-profit education. So think nursing schools and art schools. And they were better at generating those leads, and then they'd sell that lead to the school, because the school just viewed it as one more channel to go after, right? So, and then you just have to be better at working your way down. It's super competitive. Like, I love that business. I've had a couple of friends do that. There was a company in Bellevue called eFinancial that sold to a life insurance company a number of years ago. You guys may know his latest company. It was called Assurance. It sold a couple of years ago for about 2.5 billion. Right. So Mike is a super smart dude, and he just knows, right? He knows his niche really well, but his niche happens to be a pretty big niche that doesn't have a lot of innovation, like insurance. Right. So if you can be dominant in the space, it's super interesting, but just know that that's part of the challenge is if it's a big market, like All-Star Directories ended up with a ton of competitors, because everyone's like, that's a super lucrative market. We should go after that market as well. So I like that revenue model because it's easy to bootstrap. I hate it because you always have to be super competitive.
Thank you.
Isabel is asking about, she's not quite sure where she's at and wants to understand how she should be engaging in this business discovery without focusing on this attracting angel funding question.
Yeah, so I think I would at least go in with a thesis of how you're going to make money. Because again, you have the cost of building the product. Let's say that's 3 engineers in 6 months, right? Then I need to know how I'm going to sell it. So I need to know what my, past your personal network, right? So personal network's a good way to validate your idea and go sell something. The drawback is now I want to know how you're going to scale it. So are you going to do Instagram ads? Are you going to do LinkedIn ads? Are you going to do flyers? Are you going to do email lists? Like that whole thing, I would want you to at least have a thesis on it, because otherwise you'll end up building a product and find out there's no way to sell it, right? Since I've already done one of those, I would just say, don't do that. Just, personal experience, but I'm less pedantic than I used to be. I used to be like, oh, that's a dumb idea, don't do it. Now I'm like, if I were you, this is kind of what I'd want to know.
So Dave, one of the things that I see in the way that people do business is they get a lot of advice from a lot of people, which is perfectly good advice at the wrong time about the wrong piece of the business, because the company is actually in a different stage. And so I'm wondering if you have any thoughts about where this revenue question is appropriate as the stage of the company that's hearing it, right? Should I be doing this? I sort of believe that a bunch of things need to happen a lot earlier in the business before people actually commit a lot of stuff. So I have the idea in the shower, I go out for a beer and a pizza, I get the napkin out. What are the first 3 or 4 things that I ought to do on that napkin before I say, yes, I need to go find a co-founder, right?
Yeah, for me, I mean, competitive analysis, well, you guys probably wouldn't be astounded, but I'm always astounded by the number of times where I'm like, oh, well, you're like, oh, Alan, so you're like this company. And now Alan wouldn't say this because he does it well, right? But they're like, what company? Right? And they're like, I had this burning idea, I'm going to go pursue it. And I'm like, there's 6 other companies that already do that. So give you guys an example. I used to be the CEO of Codefellows. I was not the founder of it, but I came in as CEO. At one point we had 12 competitors locally, which is crazy, right? So it's just super hard business, right? So the challenge of the business, again, for me, if I was to look at the idea, I'd be like, at one point had over 100 domain names. I wouldn't spend any money on domain names, right? That's a fun exercise that gets you nowhere, right? So I think I would come up with a thesis. So Pioneer Square Labs does this super systematically, right? They're like, oh, we think this is a problem. We're going to go test or validate it. We're going to buy ads. So before they do a product at all, they've written a value proposition. They ran Instagram ads or LinkedIn ads, and they basically said, we're going to go test this value proposition against who we think our ideal customer profile is. And we're going to see if we can buy traffic at reasonable economics before we spend $1 on the product. And the answer is, I do that all day and every day. And the challenge here is, so I have bought ads for a landing page for a product that didn't exist. And some people are like, aren't you going to disappoint people? I'm like, it's an MVP. I'm going to disappoint them anyway. But what I want to know is, does anybody care about this value proposition? Can I buy traffic at reasonable economics? Because if I can get leads, I can sell them, right? If I can get leads, now I don't take their credit card, right? I throw them a 404 error, or I give them a LaunchRock page that says, sign up for the beta, right? We're currently full, right? But I'm going to test the ads and see, does this ad resonate? Because I'd rather spend $1,000 on that than a single dollar on product. But that's me.
I had a question.
Yep, go for it.
By the way, thank you so much for your talk. It was very educational. I was wondering if you could go into a little bit more detail about how to organize a subscription model. You had said that one of your favorite models was like a nuanced subscription. Could you go into some detail on that?
Yeah, so I'd say subscription, but well tuned on tiers. So if you look at the ones that have like DocuSign trades 30 times revenues, because DocuSign has a low price point and point of entry where you and I could come use it today, or a price point for a realtor, or a price point for Bank of America, right? So what I mean by that is the product is the product, but what they've really done is they've nuanced the tiers. So I know what my tiers are, where my price breaks are, how do I price them, right? Because I need to give the customer enough information to make a decision, and I need to price point their tiers as an example. So I saw a product out of New York recently, super interesting artificial intelligence, machine learning thing. I could take this video, right, from this session, run it through their program, and it would create the 10-second video snippets that mapped to my social cloud key phrases over the last year. That's awesome. Like instead of me editing video, like would edit the video for you, do the 10-second snippet, pull out and give you the phrases. I'm like, that's brilliant. But they didn't have a price that was reasonable for me. There was an agency price, $8.99 a month. And if the answer is, if you're an agency that saves a person, like it's brilliant. But if it's just me doing long form video and blog posts, I'm like, $1,000 a month is not worth it, right? So the answer is, what's the right tier and what's the right feature? So could I create a product that fits Dave's need and then feature that product up for what meets the need of an agency, and then price them differently, right? Because I don't want to give an agency price to, or the individual price to the agency, because I can charge for that. At the same time, you have to make the decision around who your ideal customer profile is, right? In their case, the question is Dave ever my ideal customer profile? Because maybe the answer is no, right? So you have to think about it that way, about who's that customer.
That was kind of one of the roots of my question, is especially trying to bootstrap a startup. So trying to define my customer well and then pricing well. So would you just build on an additional tier as the company grew?
Yeah. So what I try to do in the early stage, and this is a whole pricing seminar, and I love pricing because I'm super geeky about it. So forgive me for just a minute. You're really launching, when you launch, you're focused on who my ideal customer profile is at a very niche level. It's not everybody, right? I want to know the people who feel the most pain with the product I have at the time, who are willing to pay me for it. And then I'm going to extend to that next tier out, next tier out, next tier out, right? And then I'll look at the features and say like, oh, I think I can charge a little bit more for that, but I have to add this feature, or I have to de-feature that and let somebody use a time-based trial, right? So it's really ICP based, right? So I'm going to auger in and get super precise on my ideal customer profile, go own that customer, try to go as deep as I can and find out, oh, they don't actually like this, or, oh, they don't care, right? And then I'm going to pivot to the next ICP with the same offering. Maybe I'll change the price and value proposition slightly. But again, when you launch, you're launching for a very narrow set. And I think of it, what I wrote about in the book was 10, 100, 1,000. What most of us do as founders are like, we're going to go after the 1,000 first. Dave's wrong. I'm like, you don't have the bandwidth to go after 1,000. You don't have enough sales resources, right? It's just you. So the question is how do you get the first 10? And it's going to be hand-to-hand combat, right? At 100, I've got a salesperson or, my co-founder, but at 1,000, I have it at scale, right? But you don't start at scale. You start at 10. So is that helpful?
Yes, thank you. It answers.
Yeah, of course. Alicia?
Yeah, question on that customer persona thing. And I've talked to a ton of advisors, and I have my persona, and it's very specific, but they're all over the world. So I'm pre-launch, and I've got annual subscriptions coming in, paid subscriptions from Latin America, EU, UK, and the United States. And there's this, you got to dial it in. But all I really have to do is create a new translation, right? Translations aren't hard, and they're using the tool anyway.
Right.
So I just would welcome your thoughts on that.
Yeah, I mean, I think it's okay to be horizontal, right? But to your point around, remember Google started a social network that competed with
Orkut.
Yeah, remember that? And it was super.
I miss it.
It's super popular in Brazil, in Portuguese. Who the hell knew, right?
Yep.
But it never took off anywhere else. And the question is, that's super curious. So I would look at those as your cohort analysis, right? For most of you, you're not going to do cohort analysis this early. It's too. You only have 6 customers, right? There's no cohort to do. But for you, the question is, why are they using it there? What's unique about there? Can we launch it in a different language there? Does it change our infrastructure? And can we charge for it? So in the case of Brazil, the answer is, yeah, you could do it in Portuguese, but the economics are super tough. And, I deal a lot in MENA in the Middle East. And the answer is credit cards. What is this credit card thing? You want to online pay? So I would look at it and think of this as when you think about product roadmaps, one of the things we typically agree on product teams is we don't want to be in a feature battle, right? So we're going to say what things are important to us. So as an organization, we're going to say customer acquisition, retention, cash flow, or customer acquisition, retention, validation. And then when I choose my features, I'm going to be like, oh, does that feature map to customer acquisition? And they're like, nope. I'm like, okay, that feature goes down because we decided customer acquisition was our #1 priority. So as you look at market by market, what your opportunity is, I look at it very much like a product feature list. Before you get to the features, talk about your priorities. It's customer acquisition, it's retention, it's about getting paid for it. Prioritize and test around those markets, because you can go to the other markets that don't pay later, but be super cautious of vanity metrics, right? So vanity metrics are tough. So sometimes vanity metrics are really interesting. So in the case of OfferUp, you guys know OfferUp, they're based here in Bellevue. When OfferUp raised money at a big number, everybody's like, that's crazy. You can't buy anything. Right. So an OfferUp was, for those of you who don't know, is basically a mobile first, picture first version of Craigslist. When they raised money, they raised money against a version. Their customers were spending more time on site, more time in app than the average Facebook user was spending on a daily basis. So when they raised money to post money value of over $1 billion. Right? Because people are just like garage sales scrolling through that thing all freaking day. And the answer was, you'll figure it out, but your time on site, time in app is just monster numbers. That's why Nick and team raised such a big number. So, but again, that's not a vanity metric. That is a key metric. But in the early days, listen, you may come up with your own key metric like Nick's. In the meantime, go back to that list that I sent you today. I put the link to everybody again. And figure out what your key metrics are, because I've listed most common key metrics for each revenue model. So start there. Don't start with the vanity metrics. Start with the unit economic metrics first. So, John, thanks so much for the time. Let me hang out with you guys.
Thank you so much for doing this. I think it was a great conversation. If you're up for it, I'd love to have you do something around pricing in more details sometime in one of our future ones.
You bet.
I'll connect with you on that. Thank you for coming and thank you for doing this. We have a little bit of magic for companies that are applying for the Seattle Angel Conference. The first 25 companies that apply get a copy of Dave's book for free. And it turns out that I've only got 19 companies that have signed up so far. So the next 7 that sign up will get a copy of his book. There's an offer of one kind or another. We're doing these workshop series every Tuesday night and every Thursday noon. The next one is this Thursday about HubSpot and trying to get your marketing organized a little bit. And so please make sure you take the time to look at our upcoming ones. I've just added two new ones, and that'll fill out the month of August. We'd love to see you. And if you're confused about any of this stuff and you want to just chat, we do an open coffee every Tuesday morning. We'd be glad to have you there. Thanks so much again, Dave. I really appreciate it. And hopefully we'll see all of you on Thursday.